Hello and welcome to today's video, which is called Mapping Risk on Turn in S&P 500 following Friday's short squeeze. What kind of economic data are ahead of us today, what kind of reaction, and how the charts look pre-market. So let's dive right into it. You know full well what I do on my side for clients swing and intraday. Such was the situation on the hourly chart S&P 500 following Friday's close. You will see me further on drawing intraday levels, supports and resistances, how the price action had been moving through, testing these, so we will cover these as well. If you had already reviewed Saturday's extensive video, you are at a great advantage, because I will be right now presenting you just mere snapshots of that long video, which would be relevant to today's situation. So consider this as a refresher and update with most just right now unfolding price action and what I see going on. This is the situation Monday pre-market. We had seen indeed bearish Sunday open, as I called for, and within the context of this short squeeze, which had been quite broad-based, and I had already mentioned that 90% of issues were advancing. However, this was to be balanced by lower than expected, one of the lowest actually lately, daily volumes, which makes it suspect the risk on turn, I mean. But that does not mean that it cannot continue for a little while, and within this video we will balance the signs speaking one way or the other and what I expect to be going on. Such is the situation in Nasdaq. If you compare back to this S&P 500, we still see that Nasdaq is leading, which is one of the risk on features, and I had been already clear about Nvidia being in the driver's seat, yet at the same time that this stock itself right now cannot support the whole market. And given the event that the company is having and the interest that it is bringing, I wonder whether and how far through the $130 level this stock can make. So is it a genuine run-up or buying the hype? Remains to be seen, and the clues will be introduced later on. Such was the situation Friday, and what has happened today pre-market. 5,615 had been broken to the downside. However, prices rejected that level and returned back to the 5,615 to 5,635 range, and they are now close to the upper border of that channel. Thank you for liking these videos and subscribing to the channel. Your likes help greatly. I had been, within the Saturday's video, I had been mentioning the one-day breadth sectoral view, that it is quite risk on. You can see, for example, for yourself, discretionaries to staples as one of those ratios that make sense to be examining. Or you can see financials to utilities. That's as well another one of those that I use. Both are leaning risk on. However, I already mentioned the daily volume slight issue, and as well I had covered at length the 5-day perspective of the sectoral advances, which is not at all risk on. However, stocks are at very oversold levels, and I've been clear it can take a few days for the short squeeze to fizzle out before the price advance gets dialed back again. Saturday I've covered this market breadth perspective, covering various percentages of stocks trading above various moving averages, so make sure to review that as regards my thoughts on when we can see bottom. And same goes for still dialed back and distributive view of S&P 500 as per the McLeod's summation index, which is one of the slowest moving but very reliable tools for long-term traders. But what is most relevant right now is various volatility perspectives. VIX to short-term VIX. This is not yet in the process of calming down in earnest, and that's a very important sign in itself. However, VIX is showing a fake sign of complacency. This would come back to bite, and there would be an uptick in volatility. And it's a question of time, of a couple of days. So, summing up with a few relevant tweets, you had seen me calling for Sunday open to be on the bearish note. I had been as well suspect as regards consumer data, because that's what it started. The jobs market data on beautiful Friday, and we can see continued consumer retrenching. What's up? Retail sales and one regional survey of manufacturing activity. On balance, I expect that this would lean towards the bring on those rate cuts sooner. That would be the market takeaway of these data, which would come in on the relatively weaker side. It's hard to predict the manufacturing part, because these regional surveys are notoriously volatile. But we can see a clear pattern of retail stocks and select, for example, apparel stocks, airline stocks, hospitality, and basically from bookings to Expedia, taking note of consumer hesitation and record low consumer confidence, as Friday's University of Michigan data revealed. So, summing up those four elements, why I see the sellers as likely to return, and the only question is timing and how many resistances would be overcome. Right now it's about the question mark for 5,635, and the following one is more than 2,000 points higher from that area. I mentioned the volume, I mentioned volatility, because one has to catch to the other, and I do not think that the VIX to short-term VIX ratio would see a pronounced retreat in its values. The market breadth examination is not yet leaning on a stable risk on side. This is not yet sufficiently bringing in strong enough evidence of a risk on turn that can last for more than a couple of days. My join page will help you select right for you based on what and how you trade. You know my journey and obligatory disclaimer, and let's get on to the charts right after the opening bell again.